Hello, my name is Nelson Dong, a student at Penn, and I'll be presenting a comparative analysis of Nissan and BYD. Nissan is engaged in the manufacture and sale of automotives with a focus on sedans. BYD also manufactures and sells cars and buses, with market leadership in plug-in electric cars. Below is a plot of annual returns for Nissan, the black line, and BYD, the blue line. Nissan is geographically diverse with an increasing presence in the US, Canada, and Mexico, and BYD much less so since it's based in and focused on China. Here we see Nissan's market-implied CFROI projected to fall into the negatives, and assets are expected to grow at a negative market-implied clip as well. But Holt keeps the figures positive due to mean reversion. BYD, on the other hand, has market expectations roughly lining up with Holt figures. Both companies are experiencing fade and have struggled to post higher CFROIs than discount rates after the financial crisis. Afterwards, asset growth for Nissan rose slowly, increasing CFROI from its trough levels. 2017 guidance was conservative and was reflected in both market and Holt figures. Americans are also starting to demonstrate a preference for SUVs and trucks over sedans, so Nissan's been forced to discount its sedans while ramping SUV development. But what's causing the discrepancy seen in 2021? First, let's look at American Auto. Expectations are low due to the mounting concerns over the industry being at the peak of a cycle, but Nissan seems to have weathered the storm and set all-time highs for unit sales and revenue during March. Now, market-implied relative wealth figures in 2021 seem to reflect a potential upcoming trough in the U.S. auto business cycle, but not a long-term view. Because leading auto companies like Nissan tend to stick around for a while, reverting to 3% CFROI long-term is more predictive of intrinsic equity value than the recency-biased market-implied rates. So the T+5 assumptions are a bit flawed, creating outsized upside potential. As for BYD, the company's phase of explosive growth seems to be nearing an end, with a much-needed subsidy from the Chinese government being reduced due to oversupply, lowering margins. Now, using traditional valuation multiples, we find that Nissan is undervalued, while posting the highest dividend yield of its peer group, which mirrors its strong free cash flow generation. In BYD, we observe the opposite. In fact, BYD hasn't been able to generate positive free cash flows since 2009. Now to valuation matrices. We get a largely upside-oriented profile for Nissan with bounds between market-implied and Holt rates, but one that's a lot more mixed for BYD using default bounds. So in conclusion, I believe Nissan is a buy for being fundamentally sound and for the speculative nature of bearish market-implied rates. BYD is a hold for its weaker fundamentals, but we can't gain conviction on it as a short because of the growth potential of electric vehicles and high revenue CAGR. And that concludes the analysis. Thank you all for listening.